Hey, what if I told you that you could start building wealth in 2025 with just a few bucks and a smartphone? I'm at a MoneyMint YouTube channel, and today, I'm breaking down 5 dead simple steps to start investing, even if you've never done it before. Seriously, no complicated finance degree is needed here, just a willingness to learn and take that first step towards a wealthier future. We're going to make this super straightforward, so you can walk away from this video feeling confident and ready to go. Stick around because step 4 is an absolute game changer and could literally save you thousands, maybe even make you thousands more over time by putting your investments on autopilot. And trust me, you don't want to miss the insights on how to make your money work for you, instead of you always working for your money. We're all about practical, actionable advice here. And hey, if you're new here to the MoneyMint YouTube channel and you're keen on getting smarter with your money, building wealth, and achieving financial freedom, then do yourself a solid favor. Hit that subscribe button right now, and don't forget to ring the notification bell. That way, you'll never miss out on a money tip or an update that could genuinely change your financial life for the better. Let's get into it. Alright, let's dive straight into step 1, and honestly, this is the foundation for everything else we're going to talk about today. You absolutely to know your why. What I mean by that is, what are your financial goals? Why are you even thinking about investing in the first place? Is it for that comfortable retirement where you're sipping chai on a beach somewhere? Or maybe it's for a down payment on your dream home, funding your kids' education, or simply achieving that incredible feeling of financial freedom where you call the shots. Without clear goals, it's like trying to drive to a new city without a map or GPS. You'll just wander aimlessly, and chances are, you won't get very far, or you'll get frustrated and give up. Clear, well-defined goals are what will keep you motivated, especially when the market gets a little choppy or when life throws you a curveball. They are your North Star, guiding your decisions and keeping you on track. Think about it this way. If your goal is to save up, say, $10,000 for a down payment on a car in the next 5 years, your investment strategy, your risk tolerance, and the types of investments you choose will be vastly different than if you're trying to save $1,000 for an awesome vacation next year. The timeline and the amount dictate the approach. A shorter timeline usually means you want lower risk options, while a longer timeline might allow for a bit more growth-oriented and potentially higher risk investments. So, what I want you to do, and I'm serious about this, grab a pen and paper or open up a notes app right now, is to write down your financial goals. Don't just think about them, physically write them down. Be specific. How much do you need? By when do you need it? The more detailed you are, the more real it becomes, and the easier it will be to plan. Categorize these goals into short-term, let's say anything within the next 1 to 3 years. This could be things like building that emergency fund we'll talk about next, paying off a small debt, or saving for a specific purchase. Then, think about your medium-term goals, perhaps 3 to 10 years out. This might be that house down payment, starting a business, or a major renovation. And then, of course, there are the long-term goals. We're talking 10, 20, even 30-plus years down the line. Alright, moving on to step 2, and this one is non-negotiable, folks. Seriously, if you take only one thing away from the early part of this video, let it be this. You build an emergency fund, you start seriously investing. I know it's not the sexiest part of personal finance. It's not going to give you those thrilling stock market stories to tell at parties, but trust me, it's the bedrock of a solid financial plan. So, what is an emergency fund? It's essentially a stash of cash, easily accessible, set aside for those unexpected life events that can, and often do, pop up. Think of it as your personal financial firefighter, ready to put out those sudden blazes without you having to resort to drastic measures. We're talking about things like an urgent car repair, an unexpected medical bill, a sudden job loss, or a vital home appliance breaking down. The general rule of thumb, and what most financial experts recommend, is to save about 3 to 6 months worth of essential living expenses. Now, essential is the key word here. This isn't 3 to 6 months of your total income or your fund money. It's the bare minimum you need to cover your non-negotiables. Rent or mortgage, utilities, food, transportation, insurance. The things you absolutely have to pay to keep the lights on and a roof over your head. Why is this so critically important before investing? Imagine this scenario. You've just started investing, you're excited, your money is in the market, then, bam! Your car breaks down, and it's a $1,500 repair bill. If you don't have an emergency fund, where is that money going to come from? You might be forced to sell some of your investments, and what if the market is down when that happens? You could end up selling at a loss, effectively undoing your progress and potentially costing you more in the long run. Your emergency fund acts as a buffer, a protective shield for your investments. It allows your investments to do what they're supposed to do, grow over the long term. without being prematurely rated to cover short-term crises. It gives you peace of mind, knowing that if life throws a curveball, you're prepared and you won't have to derail your long-term financial goals. Now, where should you keep this emergency fund? Definitely not under your mattress, and ideally not in your regular checking account where it's too easy to spend. The best place is a high-yield savings account. These are typically offered by online banks, and the reason they're high yield is that they usually offer much better interest rates than traditional brick-and-mortar banks. Right now, as of late 2024, looking towards 2025, you can find some online banks like Ali Bank or Marcus by Goldman Sachs offering interest rates over 4%, sometimes even higher. This means your emergency fund isn't just sitting there, it's actually earning you a little bit of passive income while it waits to be needed. It won't make you rich, but it helps combat inflation. Chapter 3. Okay, so you've set your goals and you've built up that all-important emergency fund. Fantastic. Now we're at step 3. And this is where things start to get a bit more exciting for many people. Choosing your first investment. Now, if you're a beginner, my strongest recommendation and what I tell pretty much everyone starting out is to keep it simple. Seriously, you don't need to be a Wall Street wizard or spend hours analyzing obscure company reports. For most beginners, the absolute best place to start is with low-cost index funds or exchange-traded funds, often called ETFs. Specifically, something like an S&P 500 index fund or ETF is a brilliant choice. What these do is they track a major market index like the S&P 500, which represents the 500 largest publicly traded companies in the US. Think Apple, Microsoft, Amazon, all the big names. The beauty of an index fund or ETF is that you're not betting all your money on the success or failure of just one single company. Instead, you're getting instant diversification. Your money is spread across hundreds of companies, which significantly reduces your risk compared to picking individual stocks. If one company in the index has a bad year, it's often offset by others doing well. You're essentially betting on the overall growth of the economy. Historically, the S&P 500 has returned an average of around 10% per year. Now that's a long-term average, and some years will be up, some will be down. After you factor in inflation, you're typically looking at a real return of about 7 to 8% annually over the long haul. That's a pretty solid return for a relatively hands-off investment. And the low-cost part is crucial. You want funds with very low expense ratios because fees can eat into your returns over time. The great news is that getting started with these is easier than ever. Brokerage platforms like Fidelity, Vanguard, or Charles Schwab make it incredibly simple to open an account and buy these index funds or ETFs. Chapter 4. Alright, we've reached step 4, and let me tell you, this one is an absolute game changer. If there's one habit that can supercharge your investing journey with minimal ongoing effort, it's this. Automate your investing. Seriously, this is the secret sauce that helps you stay consistent, avoid emotional decisions, and harness the incredible power of compound interest over time. This is where you put your wealth building on autopilot. So, what do I mean by automating your investing? It's simple. You set up regular automatic transfers from your bank account directly into your investment account. This could be weekly, bi-weekly, or monthly, whatever aligns with your pay cycle and budget, and the amount doesn't have to be huge to start. Even if it's just $25, $50, or $100 a month, the key is consistency. Think about it. How many times have you told yourself, okay, I'll invest whatever is left over at the end of the month, and then the end of the month rolls around and somehow there's not much left, right? Life happens, expenses pop up. By automating your investments, you're essentially paying yourself first. That money gets whisked away into your investment account before you even have a chance to miss it or spend it on something else. There are several fantastic apps and platforms out there that make automation incredibly easy. Some apps like Acorns, for example, have features that round up your everyday purchases to the nearest dollar and invest the spare change. So, if you buy a coffee for $3.50, Acorns can round it up to $4 and invest that extra 50 cents for you. It seems small, but those little bits add up significantly over time. Other platforms like Wealthfront or Betterment, which are often called robo-advisors, allow you to set up recurring deposits easily. You link your bank account, decide how much you want to invest and how often, and they take care of the rest, often investing it into a diversified portfolio tailored to your risk tolerance and goals. Even traditional brokerages like Fidelity and Vanguard allow you to set up automatic investment plans into mutual funds or ETFs. One of the biggest psychological benefits of automation is that it removes the stress and temptation of trying to time the market. This is where people try to guess the perfect moment to buy low and sell high. Let me be crystal clear, trying to time the market consistently is nearly impossible, even for seasoned professionals. Most people who try it end up underperforming those who just invest regularly and stay the course. When you automate, you're practicing something called dollar cost averaging. Chapter 5. We're at our final step, Step 5, and this one is all about the long game. Educate yourself continuously. Investing isn't a set it and forget it kind of deal where you just make one decision and you're done forever. While automation, as we just discussed, handles the consistency, your understanding and knowledge need to keep growing. The financial world evolves, new opportunities arise, and your own circumstances will change. Continuous learning is key to making better decisions and adapting effectively. Think of it this way: you wouldn't expect to become a great cook after reading just one recipe, right? Similarly, becoming a confident and savvy investor is an ongoing journey of learning and discovery. The more you understand about how money works, how markets behave, and the different investment options available, the more empowered you'll be to manage your finances effectively and achieve your goals. So where can you find reliable information and keep learning? Well, first off, you're already doing a great job by watching videos like this one. There are many fantastic creators out there offering free, high-quality financial education. Channels like, dare I say, my own, if you find my style helpful, or others like Andre Geek, The Plain Bagel, or Meet Kevin, offer a wealth of insights on various investing topics, market updates, and personal finance strategies. Just be sure to look for creators who are transparent and offer balanced perspectives. Books are another incredible resource. There are some timeless classics that every investor should consider reading. A personal favorite, especially for those who love the simplicity of index fund investing, is The Simple Path to Wealth by J.L. Collins. It's straightforward, no nonsense, and incredibly motivating. Other great reads include The Intelligent Investor by Benjamin Graham, though it's a bit dense for absolute beginners, or A Random Walk Down Wall Street by Burton Malkiel. I'll drop some Amazon affiliate links in the description if you're interested. Upbeat music resumes, fades in slightly under voice. That's it, 5 simple, actionable steps to start investing in 2025. It really doesn't have to be complicated. To quickly recap what we covered: Step 1, set those crystal clear financial goals, know your why. Step 2, build that essential emergency fund to protect yourself and your investments. Step 3, pick beginner-friendly investments like low-cost index funds or ETFs. Step 4, automate your investing to stay consistent and harness compound interest. That's the real game changer. And finally, Step 5, commit to continuously educating yourself. Which of these steps are you going to start working on this week? Or maybe you've already got some of them covered. Let me know down in the comments below. I genuinely love hearing from you and seeing how you're progressing on your financial journey. Your story might even inspire someone else. If you found this video helpful and you're feeling more confident about starting your investment journey, please give this video a big thumbs up. It really helps the channel out. Share it with a friend or family member who might also benefit from this information. And of course, if you haven't already, make sure you subscribe to hit that notification bell for more practical money tips and financial guidance. Don't forget to check out the links in the description below to get started with some of the recommended apps and platforms like Vanguard, Fidelity, or Robinhood. Your affiliate links will be here. Thanks so much for watching, and I'll see you in the next video. End screen appears, subscribe button, recommendations for other relevant videos on the channel, and clear prompts links for affiliate products mentioned like Vanguard, Robinhood, YNAB, Acorns, book links, etc.